two best-of-breed retail stocks, Target and Urban Outfitters, are just a stone throw away from hitting 52-week lows. What gives? Wall Street strategies analyst Brian Sozzi says to blame it on margins.
With Urban, the fashion cycle has gone against them. I think they've had to mark down a little more product than they would like, and you don't want to see that from a supposed fashion leader like Urban. And keep in mind, that comes when product costs are significantly on the rise, specifically cotton. And with Target, too, their margin structure is changing. A couple of years ago, it was all about cheap chic apparel and home goods. Right now, it's about a mix of home goods and food, with food actually winning out, and their gross margin structure is starting to change. Also, within that 5% rewards, Red Card rewards program they launched last year, while it was supposed to bring a boost to comparable store sales, it hasn't done so yet. I think at this point you're looking at getting into Target before you do Urban Outfitters. Sentiment on Urban is quite low, and yet it's still valued pretty rich relative to its most directly peers, which are performing significantly better than Urban at this point, given greater international exposure and just better traction behind their U.S. business. I think as Target approaches its 52-week low, I think you'll see many analysts start to make some valuation calls here, upgrading their ratings, and I couldn't really argue with them. I think the valuation is getting pretty attractive. The stock is going to yield a little bit over 2%, so there is reason to get at least maybe a little more constructive on the name.